Hello guys, welcome back to another video, and today we're going to be doing a little bit of an analysis on AT&T. Now, if you guys don't have any background on AT&T, they're one of the strongest starting dividend yielding companies on the stock market currently. However, when we're looking back, comparing AT&T to where they were about 5 years ago, they've currently seen quite a bit of a drawdown. You see, 5 years ago, they're down 22%. Now, I will still say that their dividend yield is still pretty close to 5%. Now, this is pretty important because some people may see AT&T as trading at a discount in comparison to other communication companies like Verizon and T-Mobile. So if we take AT&T and we compare it here to Verizon, when we're looking back 5 years, Verizon is also down 29%. But when we look at T-Mobile company here, they're up 200% over the past 5 years. Now, a lot of people will like to point to the Warner Media spinoff that AT&T recently created. I believe that happened back in 2022. And as a result of that spinoff, current shareholders, I believe, got 1 share of the Warner Media if they had 4 shares of AT&T. So far, that spinoff hasn't been very successful, and people like to point to that as kind of the main reason why AT&T has seen its drawdown. And as we see here, the beginning here of 2022, that's kind of when they saw one of their lowest points in the company history. But now we're currently sitting at $22 per share. Now, the important thing is looking at the year to date, they're currently up 35%. So if you got back in on AT&T earlier in 2024, you'd be sitting on a pretty solid return currently. If you guys are enjoying this video so far, be sure to like and subscribe. It really helps out the channel and I appreciate it so much. So let's go on ahead and jump over to Seeking Alpha, where we have the dividend yield and the dividend history. So when we look at this dividend history here, right after that Warner Media spinoff, their dividends went down quite a bit actually. They went from paying 39 cents quarterly to about 28 cents. Now, that's a little concerning. A lot of that free cash flow that's used to pay out dividends to investors was a lot of it was reallocated towards that Warner Media spinoff. Now, another important thing here to look at is dividend yield history. Now, if we go to this yield on cost chart here, we can see that if you bought into AT&T 5 years ago, you would be sitting on 2.81% yield on cost, which is really bad. And when we look at this yield on cost chart, on Seeking Alpha, we typically like to see an upward sloping left to right graph, because essentially what that means is the earlier you bought in on the stock, the higher your yield on that cost is. And as we can see here, pretty much the opposite. Right here we have the yield on cost to be what it is currently at 5%. Now, that's a little concerning. However, as we see here in this year-to-date chart, when they were down at that $16.90 a share, they were able to convert that all the way back up to $22 per share. Now, jumping over to this discounted cash flow analysis model, we can kind of analyze their cash flow over time and see what it's kind of doing. So we see here in 2019, they had that 29% growth over year. And then in 2020, they saw a decline, which is pretty typical with most companies following COVID-19. But then in 2021, we also had this 3% drawdown. And then in 2022, this is the really alarming thing, that 53% negative growth. As we can see, though, in 2023, they rose back up to 65%, and they're still sitting below their prior years in terms of their free cash flows, but as we can see, that number is increasing. So when we look at this discounted cash flow analysis, it essentially projects the future cash flows of the company with a year-over-year growth rate. So we have this average growth rate of 14%, and then we have the projected growth rate at 2%, which is a pretty general consensus opinion from most analysts. If we actually go to the company analysis here, this growth estimate, this next quarter they have 2%, current quarter's negative 8%, and next year is going to be about 2%. So I personally feel that this 2% growth rate is pretty fair. When plugging all of this into the discounted cash flow analysis, we get a estimated price per share of 28.65. It's very important too to also implement a margin of error, because as we know, these cash flow analyses they're very hit or miss. Okay, it gives us a good basis, but there's also more guesswork that goes into it. So having that margin of error is pretty fair. And as we can see, post margin of error, we get a value of 22.92. Currently, AT&T is sitting at 22.68. Now, when we compare the analyst price targets to that discounted cash flow, the highest is $30, average is $23.28, and then in our original we have $28.65. So that's kind of right in line with what investors are thinking here. One of the important things to look at also is the shares outstanding. They currently have 7 billion shares outstanding. Looking at this data here, it shows this growth of shares outstanding over time. But I will say that this doesn't go far enough back. Now, if we look at this macro trends here, we can currently see, over time, back in 2009, they had that 5.9 billion shares outstanding, all the way up to today where we have that 7.1 billion shares outstanding. So over time, the company's actually diluting shareholders' equity over time. And we can kind of see in that past 5 years chart, we can see that they increased their shares outstanding by almost $500 million in only 1 year. Now that we've gone over a lot of the negatives, I would like to instead focus on the positives. So in the recent Q3 earnings release, in comparison with last year, they aren't doing terrible. So here we have that financial summary. We can see that their EBITDA, they've decreased their revenues by just 0.2, isn't terrible. Their EPS has gone down by 4 cents a share, which is a little bit alarming. And then their free cash flow has decreased a little bit too. However, jumping down here, their consumer wireless results, which is a main component of AT&T's sales and their revenues, we can see that over time their broadband revenues in billions are increasing. So from 2021 to 24, we have about a $0.5 billion increase. And then right here, if we jump to their Q3 highlights, we can see that their broadband, they're adding 200,000. Their phone subscriber base, they're also adding 400,000. And another important thing to point to on their Q3 earnings here is their net debt, which they are decreasing. As we can see, they've decreased it by about $3 billion. I would like to say is pretty important because AT&T has also announced that they've acquired some of US Cellular. So here we see actually that US Cellular announced a sale of select spectrum assets for $1 billion. So AT&T is still making good use of their debt while still decreasing it. And from my understanding from this sale of assets, it's essentially like cellular licenses, so they get more service throughout the United States. That's just very surface level analysis though of this acquisition. I'm not entirely sure all of the details on it. Now, jumping back over to this intrinsic value here, as we can see on their DCF, they're evaluated at around what they're selling for. If we look at their dividend discount model, so we kind of see their yearly dividends, they had that sharp decrease and then they've stayed about the same with that average growth rate of -7%. If we're a little bit optimistic, we could say that their growth rate's going to be closer to 3%. Their dividend growth is entirely dependent on what you think about the company. Because of that Warner Media spinoff, that is a result of the sharp decrease in their dividend payment. So as we go into the future, if you believe that they're going to increase those dividends back to what they were around their 2019, 2018 years, then I believe a 3% growth rate is entirely fair. And once we plug that in there, we get dividend discount model price per share of $20.79. So when looking at AT&T as a company into the future, it's very important to realize that they are a service provider, and there's not very many service providers left in the United States. Most of them are getting bought up, especially the smaller like pay-as-you-go or prepaid wireless services are getting bought up by these big communication service giants. Another important thing is when you compare them with Verizon Communications, their performance in the 5-year is similar, and AT&T is actually beating them in the year-to-date and the 1 year. However, the last negative that I'd really like to point out is T-Mobile Company in comparison with AT&T. As you can see, that 5-year, they're up 200%. In the 1 year, they're up 60%, and their year-to-date, they're up 46%. So the growth when comparing AT&T to T-Mobile, you can definitely tell that T-Mobile is the better growing company as of right now. However, they do offer a lower dividend yield. So if, for example, I was interested in that high yield consecutive dividend payment, I would be more inclined to purchase AT&T as we can see in the past year, they've had some growth, and their starting dividend yield is just much higher than T-Mobile. However, if you're really looking to ride the growth of T-Mobile, then it could also be a pretty solid play, and your yield on cost will increase over time. So essentially, in my opinion, it's all down to your personal preference, whether you want that high starting dividend yield right now and you believe in the either sideways trend or small growth of a company like AT&T. Now, if you're more into it for stock price appreciation, I would personally say that T-Mobile would be a better play for you. So again, guys, it's all down to personal preference, and if you look at the analyst estimates, they're all within reason of these analysis models. Personally, I have a position, a very, very small position in AT&T. I think that their opportunity for growth and getting back to where they were pre-COVID and pre-Warner Media spinoff is very likely. Since this communication services market is dominated by very few companies, I feel like they are pretty safe into the future. So if you guys enjoyed this video, make sure to like and subscribe and let me know what you want to see in the next video. And as always, I'll see you guys later.